Okay, so today we're doing consolidations. Most of you, who's actually done consolidations before? No? No? Yes, a few of you have. So basically what we're doing is we're going to be taking one company, so this company is called Big Company, and we've got Small Company, and we're basically going to treat them as though they are one company. Okay? So what we're going to do is, as you can see, we've got Big Company, we've got Small Company. We've got in the middle of this consolidation worksheet what we're calling Consolidation Adjustments, or they've called them Eliminations and Adjustments. So as you can see here, we've got accounts payable, 2,500, 250 is in the Small Company, and generally what happens is we add the two together. 2.5 plus 250 and we get the 2,750. Okay. But in this case here, let's take a good one. So we've got 175 and 125 dividends payable. And as you can see, we've got an adjustment there of 125. So we've got 175, we've got the Small Company with dividends payable of 125, and then we've got a debit of 125. But basically what we've done here is we're going to say 175 plus 125 minus 125 gives us our group figure, or consolidated figure, which is 175. So the question is, why do we end up with 175 instead of 175 plus 125, which gives us 300? Why do you think we subtract 125? What do you think it could be? An expense, okay. It's basically what's happening here is that any transactions which take place between Big Company and Small Company, the effects of those transactions must be eliminated. And why do you think that has to happen? Why do we have to eliminate any transactions that take place between the two of them, Big Company and Small Company?
Because it's only one company, so we can't split that for two companies anymore.
Exactly. We're treating it as though we're treating these two companies as though they're one company. So therefore, we have to eliminate any transactions which take place between those two companies. Okay? Because you can't transact with yourself. Okay? So basically, we end up with the 175. Obviously, this dividend, okay, Small Company happens to be 100% owned. In other words, the shares of Small Company are owned 100% by Big Company. So therefore, if those shares are owned 100% by Big Company, then obviously all of those dividends are going to be paid to Big Company. So therefore, we eliminate the dividends which are payable by Small Company because they are obviously going to Big Company. So any transactions which are taking place between these two will be eliminated, which is why we do eliminate the 125, which is going to go to Big Company. Okay, and we end up with dividends payable for the group. In other words, dividends that are payable outside of the group are 175. Okay, so all I'm showing you here is basically we do this worksheet, and the first column of the worksheet is the first company in the group. Obviously the second company there is also in the group. And what we generally do is we simply go, okay, 1,200 plus 775, okay, gives us 1,225. And that doesn't look right, does it? There's an adjustment, obviously. Let me take a better figure. The 2,500 plus 250 gives us the 2,750. That's what normally happens, right? We're just adding the two companies together to give us the group figure. But obviously we have to bear in mind that any intercompany transactions or any transactions that are taking place between one of the companies and the other within the group must be eliminated. Okay. So let me just take, for example, and then let's just start with this. So if, for example, we have Big Company sells $10,000 worth of inventory to a small company, okay, the stock, the inventory cost big company, say it's cost big company, actually I'm going to make this 20 and I'm going to say it cost big company 10. Right. Okay, so this is a very common thing that happens. You have inventory being sold from the one company to the other company, and both of those companies are within the same group. Okay, it's a big company, and this is the parent company. Parent company owns shares in the small company, which is what we call the subsidiary company, or the subsidiary. Generally, if a company owns greater than 50% of the shares of another company, then we call that company that owns the shares the parent company, and the company that they own the shares in, we call that the subsidiary. Okay, so in this case, we've got the parent company selling $20,000 worth of stock to the subsidiary. The inventory cost big company. So when big company originally purchased the stock, it cost big company $10,000. And let's say that all of the inventory is on hand at small company, okay, at year end. Right? Okay, so what we're going to do is we've got obviously a transaction that's happened between parent and subsidiary. And we've got to eliminate the effects of that transaction. So in other words, we've got to basically treat it as though it never happened. Okay? In the books of the group, the effects of that transaction must not be present. Okay? So what we're going to do, and there's a pretty standard journal entry for this one. Okay, I'm going to debit sales. Okay, obviously this, because it's inventory, we're not only dealing with just a couple of debits and credits. The inventory is going to affect the sales account, it's going to affect cost of sales, it's going to affect inventory, it's going to affect tax. So there's quite a few things that are going to be affected by this particular transaction. Okay, so I'm going to put these, and the second journal entry is to do with the tax effect. It's also pretty standard. Okay, I'll deal with that just now. So we've got debit sales, credit cost of sales, credit inventory. What we're going to do here is just look at what would happen in the books of big company and small company, right? So they're going to treat, in the books of big company, they're obviously going to treat that as a sale, okay? They, as an individual company, when they do their own individual books, they're obviously taking that transaction into account, right? So in the books of big company, we're going to have sales, they're going to credit sales, sold $20,000 of inventory, credit sales, and they're going to have debit cost of sales, 10,000, right? And what else would they have there? Oh, sorry, it'll be the other way around, won't it? So credit sales, and we're going to debit cost of sales with 10,000, yeah? And what else would we have in the books of big company? Tax. We're going to have tax, so we'll deal with that a bit later. But basically they've got sales of 20, and obviously they've incurred cost of sales of 10. You agree with that? Okay. In the books of small company, okay, we're going to debit inventory. Would you agree?
Yeah.
We're going to debit inventory with what? Yeah, so small company has now got inventory of 20,000. Obviously, cash has moved, so we're going to credit cash here, say 20,000. These guys are obviously going to get cash, so we're going to have a debit of cash of 20. Right? Okay. So basically, if we actually just turn this around a bit, obviously those two are going to go together. So we're going to have a debit cash 20, credit sales of 20, and we're going to have debit cost of sales 10, and we're going to credit inventory. Obviously assuming that we're using the perpetual system or perpetual method of accounting for sales and inventory, etc. So if we then said, okay, let's say big companies' books, small companies' books, okay, just taking that away a little bit. Sales, we're going to have 20,000, right? Nothing here. We're going to have cost of sales. What's that going to be? That's 10. Nothing there. Inventory. Obviously, we're going to take out inventory of 10. And we're going to have inventory coming in here at 20, right? So, what I want to do is say, okay, what should be in the books of the group? So, what should our sale figure be in the books of the group? Obviously, if the sale has taken place between parent and subsidiary company, then the group sales figure should be 0. Okay? Because there has been no sale that's taken place to a company outside of the group. Remember, the group is made up of these two companies. Okay? So what we're going to do is we're going to have a consolidation adjustment, aren't we? Consolidation adjustment, and obviously that consolidation adjustment is going to be a debit. So we're going to have debit sales 20,000. So therefore, this should be. This is a consolidation journal adjustment. Okay. So this is a consolidation journal adjustment. Right. The other very important thing is that when you're doing a consolidation journal adjustment, the adjustment does not in any way affect the books of big company and small company. So the consolidation adjustment does not change these figures, the figures in big and the figures in small. Okay? The only reason why we do these consolidation adjustments is in order to get group figures. So our first consolidation adjustment which goes in that worksheet is debit sales 20,000. We've then got cost of sales. Okay. What should the cost of sales be for the group, assuming that that was the only transaction that's taken place? What should it be? Has any sale taken place outside of the group? No. Yeah. There should be no sales, there should be no cost of sales. You agree? Yes. Okay. So, therefore, what are we going to do? Credit cost of sales with 10,000. Okay, credit cost of sales, 10,000. Yeah, easy. And then the last one is obviously the inventory. Okay, we've taken out 10, we've got small of 20, and therefore in the group, what is the cost? What is the inventory going to be? Sorry, this shouldn't be here actually, because basically we're looking at the books, obviously at year end, and obviously Big has got rid of the inventory. Big has got rid of the inventory, It's actually credited inventory. So the final balance in inventory is going to be 0. Okay, assuming that that was the only stock that they had. Okay, we've got in the books of small, we've got inventory valued at 20,000. What should the inventory for the group be valued at? 20,000? 10,000. Okay, why 10,000?
Starting from a big company, and it was worth 10,000.
That's right, exactly. When the inventory came into the group, so in other words, it came, obviously big company purchased it. Yeah, quite right. When big company purchased it from outside of the group, it cost 10,000. Okay, the fact that it's now been sold within the group, it's been sold to small for 20. It doesn't matter. From the group's perspective, we're only worried about how much it cost when it came into the group. The fact that it's now been sold to small within the group doesn't matter. What did it cost the group originally when it came into the group was obviously 10. Okay, so what do we do? We've got 20 here, we normally say more plus 20, and we want to end up with 10. So therefore, obviously, credit 10,000. Yeah? Easy. Okay, what I'm going to do is give you another one. So I'm going to change that to 50. I'm going to change that to 30. And I want you to do this journal entry here. So debit sales will be 50. We've got 50,000, so we sold $50,000 worth of inventory. We know obviously that that sale has taken place within the group, so we've got to take it out. The next thing that I always do is inventory. I look at inventory because that's a lot easier to work out than the cost of sales generally. In this exercise, cost of sales isn't difficult, but normally it is a little bit more complicated. So credit inventory is going to be? 20. 20? Okay, how did you get that?
30.
So 50 minus 30. Basically what we're going to say there is that the inventory when it originally came into the group, it cost 30. Okay? It's obviously sitting in the books of the subsidiary at 50. So therefore we have to knock off 20. Yep. Okay, in this case cost of sales is pretty straightforward. We know that it's 30. We've got cost of sales of 30 and we want to obviously get rid of that cost of sales because it took place within the group, between two companies within the group. Okay, what I'm going to do now is I'm going to make it a little bit more difficult. Instead of saying that all of the inventory is on hand at small company at year end, I'm going to say that half of the inventory is on hand at small company at year end. And I want you to see what you do in that case. What do you think you do in that case? In other words, half of the inventory has been sold outside of the group. Right, so what I'm going to do differently there. Okay, what I'm going to do is I'm just going to give you maybe 30 seconds to have a look at that and see what you do here, anything differently. And then I'm going to just look at this and see what's going to be in the books of big and small, and then look at what should be in the group. I'm just going to say half the inventory is on hand at small during. what we're going to have is we're going to have, in this case, we're going to have sales here would be, in the books of big, what? 50. Cost of sales would be 30. Inventory is going to be 0. Right? You're all happy with that? In the books of small, we've now got they've got sales of 40. Cost of sales would be? Okay, cost of 50, isn't it? They've sold half? 25, good. Okay, inventory sitting at? 25, quite right, it's sitting at 25. Right. So, what we're going to do now is we're going to say, okay, what should the figures be in the books of the group? Okay, so if you added those two together, 50 plus 40, you're going to get 90. Well, we've got to obviously do a consolidation adjustment. And we're only going to recognize sales that have been made outside of the group. Okay, any sales that have taken place from the group to an external company will be recognized. So therefore, what's the group sales going to be? 40. Alright, happy? Okay. Cost of sales for the group. What should the cost of sales be for the group? 25? Yes? Who thinks something else? Okay. Let me say to you that the cost of sales, basically what's happened here is that we've got 30,000, the stock has cost the group 30,000. We then sold half of that, so therefore, cost of sales for the group should be 15. In other words, should be half of what it originally cost the group. Okay? Half of that. So therefore the group cost of sales should be 15. Inventory, what should that be?
Would we add the 25,000? The small one?
So you're saying we should add what?
Just 25,000.
25, we should add this. You're quite right actually. 25 plus, except, just bear in mind, no. Okay, that 30,000 we're not recognizing. Why aren't we recognizing that? Okay. Just remember when that sale took place, it was too small. So we're not recognizing that at all, are we? Just like we're not recognizing that. What are we recognizing here? We're recognizing this sale because that sale took place to a company external to the group. Right? But we know that, Small's going to record that at 25,000 because Small bought the stock for 50. Right? However, remember what we've got to say is how much, okay, yes, we sold this stock to a company outside of the group, but what did it cost when we bought that stock originally? In other words, what did it cost the group? It cost the group 30. So if we've sold half, what they've done here is they've said 50 times half. And that's the 25, isn't it? Right? Because obviously Small bought the stock for 50, they've sold half, so 50 times half is 25. But we're looking from the group's perspective. How much did the stock cost the group? It cost the group 30. And we sold half of that outside. So it's going to be a cost of sales for the group of 15. Would it be correct if we said that the group's cost of sales was 25? No, because originally that stock cost us 30. If we say the cost of sales is then 25, we're not actually taking half of 30. We're taking half of what it cost Small. Okay, so basically the group cost of sales should be 15. Hopefully look at that again and you'll hopefully come to be happy with that figure. Inventory. Inventory sitting in the books of Small, 25. What should it be in the books of the group? Okay, it should be what, half of what? We've got half of the stock
Of 30.
of 30, so it should be
50.
quite right. Okay, so once we've done that, pretty straightforward to do this little calculation here. We're going to have debit sales 50. Yep. Obviously, I would do this one next, and I'd say, okay, inventory is sitting at 25. It should be 15, so it's 10 here. Balancing figure, 40. Is that correct? Let's go and check it. We got 30 plus 25 is 55. We got 15,000 there. Difference. 30 plus 25 is 55. We want 40. Okay. So therefore, the adjustment is obviously going to be 40. So in other words, we're going to say cost of sales, 40,000 here. You go across 30 plus that, minus that, equals that. Yeah? Obviously sales, 50 plus 40, minus 50. Okay, this journal entry goes here in the worksheet. 50 plus 40 minus 50, 40. And obviously the inventory, we've got a credit, 10. North plus 25 minus 10 equals, right, easy. Okay, what I'm going to do now is change this to, I might just change the figures a bit. Let's make this 100, and let's make this 60. Okay, and what I want you to do is I want you to do this journal entry. What would that be? Debit sales of?
80.
Sorry?
80.
80.
180.
180. Let's look at it. Sales. Big company. What's the sales going to be in the? 100. Right. Okay, sales in the small company. 80. Okay, so we've got quarter of the inventory was on hand at small company at year end. 3/4 was sold outside the group for 80,000. Okay, so sales is going to be 80,000. For the group, we're going to have, you're quite right, we're going to have 80. We're only recognizing the sales that have been made outside the group. Okay? So we're only recognizing so if we've received $80,000 from someone outside of the group for inventory, that's our sales for the group. Okay. The fact that we had 100,000 taking place between big and small is not of any interest for the group. Okay, we're not recognizing transactions that have taken place within the group. Okay, the group has not made any profit from those transactions. Cost of sales. We've got big cost of sales is going to be 60. Small cost of sales is going to be. Okay, so we've got 100,000 was the price, the cost that they've sold 75%. Quite right. So we've got 75,000. Okay. So basically, when the stock came into the group, it cost 60. remember that when it came in? And when it went out, so the cost was 60, we've sold 3/4, and we've sold it for 80. Right. Okay, cost of sales for the group. What should the cost of sales be for the group?
45.
45. All that you do there is you say, what have we sold? What fraction have we sold outside of the group? We've sold a quarter. Sorry, 3/4. 3/4 is sold outside of the group. 1/4 is on hand. So 3/4 is sold outside of the group, and we're going to go 3/4 multiplied by the original cost. So the cost of that stock when it came into the group was 60. We've sold 3/4 of that, and you're quite right, therefore, the cost of sales for the group, 45. Okay. And obviously what we're going to have here is we're going to have debit sales 100,000, credit cost of sales, and the figure is obviously 60 plus 75, 100 and, whatever it is, 35? Okay, so what's the adjustment here? 90? Okay. So we're going to have credit here, 90, 100 here. Okay. Let's check if it's all right at the end. Inventory, what's the inventory for the group going to be? Here it's going to be 0. In the books of small company, we're going to have 1/4 on hand, purchased for 25, well done. Okay. And for the group, the inventory will be, or should be valued at, 15, right. 1/4 times 60. What did it cost originally? It cost 60. We've got 1/4 left. So 15. Okay. Credit inventory, therefore. Right. So it all works out. 100. Debit sales 100. Credit cost of sales 90, and credit inventory 10. Okay, well done if you're understanding this. It's a bit tricky the first time you hear it, but you should obviously, after doing a few examples, you're hopefully starting to get the hang of it. We're going to have a tax effect. Why are we going to have a tax effect? Because of the fact that what are we doing? We're decreasing sales by 100, and we're decreasing cost of sales by 90. Okay. This doesn't affect our profit. Credit inventory doesn't actually affect our profit directly, but obviously indirectly there is an effect. Debit sales, credit cost of sales 90. Is our profit increasing or decreasing? Sorry? Decreasing sales by 100. We're obviously decreasing our profit by 10. Okay, you decrease your income by 100, you decrease your expense by 90, what are you going to do to profit overall? You decrease it by 10, do you agree? Right, so obviously if we decrease both of these by the same amount, no impact on profit. We're decreasing expense by 90 and we're decreasing income by 100, therefore the income or the impact on profit is obviously, we're decreasing it by 10. Okay, the thing with tax is that the group doesn't pay the tax, right? The big company pays tax, small company pays tax. Okay? So what they do is they work out what tax big company should pay and what tax small company should pay. And what we do from a tax point of view, we look at okay, tax for big company is 20,000, tax for small company is 40. They've obviously recognised the profits that have taken place when they have transacted. But from the group's perspective, we don't recognise the profits that have taken place between these guys, do we? Okay? So basically what we're going to do is we're going to credit income tax expense. Okay? From the group's perspective, we have decreased profit by 10. Right? So if we've decreased group profit by 10, right? Instead of just simply adding up big profit and small profit, we then subtracted 10 overall, if you take this into account. Right? So therefore, if they've paid their taxes based on all transactions that have taken place between them, their taxes are going to be too high from the group's perspective. Would you agree? Okay. And how much is their tax going to be too high by? Obviously, 10,000 times the tax effect, yeah, 30%. So basically what we're doing here is that we're saying, from the group's perspective, we're not recognizing that 10,000 profit. We're decreasing the profits by 10,000. We're obviously decreasing inventory by 10,000. This here is regarded as being an unrealized profit on hand. Okay, so basically we're saying this here is an unrealized profit. Why is it an unrealized profit? Because the stock has not yet been sold outside of the group. Okay, it was sold within the group. That's why it's actually increased in value. Remember, think about it. It's recorded at 25, which is 1/4 of 100. It should be recorded at 1/4 of 60. So it's sitting in the books at 25, when it should be sitting in the books at 15. In other words, in that 25, which you can see down here, is an unrealized profit of 10. Okay. Okay, so anyway, let me get back to this. 3,000, we've decreased the tax by 3,000. And from the group's perspective, the individual companies have paid too much tax. They have paid tax, before it's actually been sold outside of the group. They've recognized the profits that have taken place within the group, which is fine if you're actually looking at them individually, that's fine. If you're doing the financial statements of companies on their own, yes, you do recognize those profits that have taken place when they transact. But if you look at the group, you say, no, we're not recognizing those profits. And from the group's perspective, you guys have paid too much tax. So we're treating it as a deferred tax asset. In other words, it's like from the group's perspective, we think that they've prepaid their tax. They've paid it before it's actually been sold outside of the group, before those profits have actually been realized. Does that make sense? Yeah? So, if I said to you, look, let's change this slightly. Let's say instead of having that, I had, say, 50. So we're not going into all of that. Say I had 50 here, and I had, say, 20 here, and I had 30 here. What's this going to be? What's the tax entry going to be? Yeah? 9? Okay, we've decreased income by 50, we've decreased expenses by 20. So we have obviously decreased profit by 30, which is always this figure here, isn't it? Just simply multiply that by 30%, you get 9,000 and 9,000 here. Okay. Okay, so that's easy, is it? No? Okay. What I'm going to do now is just talk a little bit about, so what we've done here is we have recognized the fact that when you're doing consolidations, you're going to be adding figures in the big company, in other words the parent, with figures in the small company, in other words the subsidiary. Okay? And what you do is you use a worksheet, and I've shown you the worksheet. But what you've got to be careful of when you're adding the parent and the subsidiary figures is that you have to take out any effects of transactions that have taken place between parent and subsidiary. Okay. So if I said to you, for example, big company has received rent from small company of $50,000. Okay. So big companies receive rent from small company of $50,000. What's your consolidation journal adjustment going to be? This one was obviously a lot more complex because we had cost of sales, inventory, sales, tax, etc. But if I just simply said to you, what if big company has received rent from small company of $30,000? Remember, you can't receive rent from yourself, okay? So what's the journal entry going to be? If we've got to just simply cancel that out, that's what we're doing. We're cancelling out the effects of the transactions that have been put in the individual companies. What would have taken place in big? So big company has received rent. So big company would have said credit rent income. And say debit cash, right? Small company would have said debit rent expense, credit cash. Well, this is nice and easy, you guys. Right? So we want to cancel out what's happened here in the consolidation adjustment. What are we going to do? These two cancel each other out, so we don't have to do anything about that, do we? Okay, we've got cash coming in, cash going out. That's fine. Okay, we've got rent expense and rent income. If you're cancelling something and it's a credit, what do you have to do? You debit it, don't you? So you debit rent income and you credit rent expense. The amount, say, is 50,000, right? Okay, is there a tax effect? Is there a tax effect? Why not? Well, what are you actually doing to the group's profit? Are you decreasing or increasing group's profit? No, why not? Because you are decreasing income by 50 and you're decreasing the expense by 50. So what's happening to the profit? Nothing. Yeah? Easy. Okay, easy. So that's straightforward. That's because of the fact that those journal entries to do with rent are actually very straightforward. You're only really affecting two or three accounts there. So these two cancel each other out. Therefore, and that's going to be a very common kind of journal entry. I could have something like a small company gets management fees from big company. We should have the other way around. I mean, it can happen either way. You can have rent going from small to big to small. Doesn't matter, it's the same journal entry. Okay? You could have management fees going from big to small to big. Yeah? And obviously it would be the same thing. You just debit the income, management fee income, and credit management fee expense. Alright? What if I said to you, this has happened? Big company has... Okay, I'm going to put a little transaction that's taken place, right? So, small company declare dividends. Okay. Okay, so I've said to you, small company declared dividends of 10,000. These dividends have not yet been paid, and let's say that big company owns all shares in small company. Okay, what are the necessary journal entries? In other words, if we're doing consolidation, what journal entries should we put through?
Dividends payable.
Dividends payable, quite right. Yeah?
Receivable.
Dividends payable, dividends receivable. Okay, so what are we going to do there? We're going to debit dividends payable, credit dividends payable. What are we going to do? Debit or credit? Dividends payable.
Debit dividend payable.
Debit dividends payable. That's right, well done. Okay, what else are we going to do? Sorry?
Credit receivable.
Credit dividends receivable. Is that all? Okay, we see you're going to have dividend income and dividend declared, or it's not an expense, so to speak. Okay, so dividend income, debit or credit? Debit, we're cancelling it. You do the opposite. And obviously dividend declared is going to be cancelled as well. Right, get that. Okay, what if I said to you that big company declared dividends of $10,000? Okay, would you need to have a journal entry? Just remember, big company is the parent. Big company is the one who owns the shares in the small company. Okay, big company is the parent. Big company controls small company. Why do I say they control small company? You can basically assume, because they're owning 100% of the shares of small company, obviously they have the final decision on anything, on any decisions that are made, because they have all the shares, so they have all the voting power. Okay? And obviously, whenever a company controls another company, we say that they then have to do consolidated financial statements. In other words, they have to do good financial statements. Right. Okay, big company declares dividends. Do we need to do any journal entries? Generally, if we're not told anything else, no. Why not? Because obviously if they've declared dividends, where are those dividends going to go? Are they going to small company? No, they're not. Remember, the small company, unless we're told something about, the fact that small company does actually own shares in big company, those dividends that big company pays are going to go somewhere else. They're going to go to the shareholders. In this case, remember, big company owns the shares in small company, so therefore, obviously, dividends paid by small company go to big company. But if big company pays dividends, they're just going outside of the group. Okay? Obviously, we unless told otherwise, small company doesn't have any shares in big company. Okay. Do you want to stop there? Okay.